Hello everybody, my name is Nicole and I'm a technical analyst and private investor. And because this afternoon we're going to have United States Consumer Price Index data, and the media has been hyperventilating about the threat of inflation for the last 3 months or so, I thought it was a good time to see how the bond market is reacting, tip-top bond market is reacting to all of the above. So my first chart is the yield on the Japanese government bond, JGB as they're called, but it's a 20-year. Don't bother looking at the 10-year because that's totally controlled by the authorities and the government. Okay, so that doesn't move. That's fixed at 10 basis points. So this one, the yield on this one in the first quarter of this year moved up to over 50 basis points. Now, this is important in that Japan is a country where they have been battling deflation, i.e. negative price rises, at least 10 years. I mean, I just lose count. They never seem to manage. And the most latest data for April showed that inflation dropped by 0.4%, and excluding fresh food, which is the preferred Japanese way of looking at inflation, it actually dropped 0.5% on the month on month. Just in 1 month, it dropped 0.5%. And you can see the effect that this has had this week with that red candle on the right-hand side of the chart. Now, the moves are small because the numbers are very, very small, but they're not negative. None of this is in negative territory. On the futures market, volume was the best since late February, early March, and open interest has picked up smartly. In other words, all of the above suggests that the break above that Fibonacci retracement resistance at 50 basis points was a spike high and a false break, which was confirmed the following week. And now we're moving into gear. There is still support from the cloud, from the trend line, and all the rest of it. So it's not going to run away from you, but certainly there's a change in tone. Something similar has happened in Australia, which has totally different dynamics from Japan, I think you will agree. Now, this is the benchmark 10-year government bond yield. And I think this one is easier to spot, isn't it? And we peaked at 2% again in March, early March, and then sort of hovered at around the sort of 1.75% for weeks and weeks and weeks on end, where the volume just was rubbish, absolute rubbish volume during April and May. And now it's picked up again. Like the JGB, both volume and open interest have picked up quite smartly this week. In other words, people are taking note and they feel they've got to do something. And that their original plan is perhaps flawed. And so what's happened to the yield is we're back down where we started off in February. I think this one could quickly drop to 1%. So it's a positive yield, but it's half of 2%. So that's quite a big move in terms of interest rates and in terms of bond prices. Be careful. Bonds and prices move inversely to each other. Here, the inflation is inflation. It's not such a problem. Recent data showed it growing at 1.1% in the first quarter of this year. My third and final chart, and this one is more interesting, I think, to me anyway, and it's the yield on an index-linked 30-year piece of British paper, government-backed paper. It's a monthly chart here, and you can quite clearly see that the secular trend is to lower yields, interspersed with periods of consolidation in a triangle. This is what we've been doing for a while. I think we've topped again at minus 1.7%, and we're on our way down. There is something you can do to protect yourself from inflation. This is it. Good luck, and I'll see you again next week.